Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can also follow me on Twitter and talk to me on Patreon. Okay, enough of you keep asking about investment advice with Leaps, so I'm going to go through the entire thing thoroughly. If you're already familiar with call options, then part of this video may be a little rudimentary for you, but I feel somewhat obliged to at least help educate those of you who have asked, in case you end up investing in Leaps without a thorough understanding and potentially lose money on a trade, and potentially through my encouragement. So I thought I should clear up as much as I could about how I invest in Leaps. And yes, I said invest, not trade. I use it as part of my investment strategy, not to speculate. To be clear, this is not me advising or suggesting you buy Leaps. It's an advanced investment strategy that I am familiar with, and I have been trading options for over 20 years. I'm just sharing my experiences with them. If you think it meets your criteria for the reasons I say and works within your strategy, then it's up to you to buy them. I will explain what they are, show you examples of them, go through various scenarios as to how much profit they can make, and explain various strategies they're used for, including why I use them. Also, if you are serious, then make sure you watch the video to the end as I explain more important strategies there. As you've seen in the past, I put my money where my mouth is and spent a significant amount of money on what is effectively just a contract. But if all my Leaps went to zero, then I'm not going to lose the shirt on my back. I walked into this with my eyes wide open with the realization that I could lose it all, and if I do, I'll get over it and move on. You win some and lose some. Also, I have won more in the past that would still mean I'm up overall on my options investing, even if I lost on these. So in a way, I am playing with house money, but I don't look at it like that anyway. First off, I think it's important to be aware that you can lose absolutely everything you invest in Leaps, every single cent. But your liability is limited there, as in you can't lose more than what you put in. And Leaps are nothing more than a call option that just happens to have an expiry date of between 1 to 2 years. 2 years is the maximum expiry date you can purchase. Leaps are an acronym for Long-Term Equity Anticipation Securities. Who are you buying these call options from? Well, these are the people selling covered calls. If you hold shares, then you can sell covered calls and generate income from your stock by selling these call options. But if Tesla's stock price did rise, then you might miss out on the gains. It is another form of trading. Let me know if any of you would like me to go over covered calls trading strategies too. But bear in mind, it's not investing, it's trading. And there's also such a thing as naked calls too, selling call options without owning the underlying security. So what is a call option? It's a contract that you buy that gives you the right, and only the right, as in you are not obligated, to buy a certain amount of Tesla shares at a certain price, before a certain date. This is called the expiry date. Each contract contains 100 shares, so if you wanted to buy the right to own 300 shares, then you only need to buy 3 contracts. Do not buy 300, or else it would cost you literally 100 times as much. Now you understand that the expiry date is when the contract no longer exists, and before the time expires you have the right to purchase this assigned number of shares at the agreed upon price. The agreed upon price is called the strike price, and the action of purchasing the shares through the contract is called exercising the options. However, you are not obligated to exercise the options either. You can just sell it back into the market and take your profit, or accept a loss. Here is an example. We have a strike price of $800, expiry date of 20th of January 2023, and the price is $156. At the time of this video, Tesla's stock price is $735, which is also an important factor. Now this kind of option is referred to as an out-of-the-money option, which means the strike price is above the stock price, and there is no intrinsic value held in the option. In other words, if you exercise this option, it would cost you $800 per share, but in the market, you can buy shares at only $735. It would not be a smart move to pay more for a share than the actual market. There will be no sense in ever exercising this option unless the stock price is above $800. However, that doesn't mean you can't make a profit unless the option is in the money. For example, if the stock price jumped to $775 in a few days after purchasing this option, that would mean the stock price jumped from $735 to $775, or $40, which is about 5%. But the price of the option may have risen from $156 to $180, or $24, which is about a 15% increase. You see, the return on the option was about 3 times as much as the stock price. This is how options are more leveraged. These are Leaps though. If it was a call option with an expiry of a month or two, the return might have been closer to 40%. depending on what strike price and expiry date you chose. Remember, there are 100 shares per contract, and if you're paying $156 per share in the options contract, then the contract will cost you $15,600, which is a lot of money for something that could eventually expire with a worthless value. No matter how rich you are, it can certainly take quite a bit of conviction to press that buy button with such an expensive trade too. The strategy is certainly not for everyone. As time goes by, if the stock price remains the same, the value of the options will fall. Time is not on your side with options, as they get closer to the expiry date. This is because there is less chance of the options increasing in value if it has less time in order to do so. Bear in mind, in this example, if you were to exercise this option, it would cost you $80,000, as it is a contract of 100 shares at $800 each. Let's take a second example using the same expiry date of 20th of January 2023 with a strike price of $600. Now this strike price is below the $735 stop price. This is referred to as in the money, as right now if you exercise this option, it will still be cheaper than buying shares at the market price. However, also note that the price is now $234, which is significantly more. Of course, there is an intrinsic value of $135 per share already. A $735 stop price minus $600 strike price is $135. So how do you know which leaps to purchase? Well, firstly, it's important to work out what expiry date you want. These days, I tend to just go as far out as I possibly can. My theory is that Tesla won't slowly go up. It will more or less remain within a certain cycle and eventually break out. This is what I've seen in the past. So I want to make sure that I manage to hang on long enough to make it to this next breakout cycle. In other words, your leaps may just move up and down a few percent for months, or even reduce in value due to the time of the expiry date approaching closer. You are not investing in slower cumulative growth. It doesn't matter for this strategy, as you're just waiting for the breakout event, and doing what you can to not miss out. If you feel like being more risky, then you could prolong the purchase for as long as you can, but missing out feels a lot worse than overpaying. In addition to that, if you're intending on exercising your leaps, i.e. converting them into shares, then it's going to require a significant amount of cash. As I said in the example, about $80,000. So you might want to make sure that you have that much money available when the time comes. That would also be in addition to purchasing the options in the first place at $15,900. So this is not cheap. This allows me more time to source funds to pay to exercise these leaps. You're literally buying more time until you can afford the amount of shares you want. So I thought we could explore 4 different leap strike prices, all at the same expiry date of June 16th, 2023. This is my preferred expiry date as it is the furthest out. If you would like to analyse different expiry dates, then by all means try them out yourself. I've left a link to download the spreadsheet in the description below. But the further out you go, the higher your chances of a breakout. But to give you an idea of the price difference, a June 2022 option at $700 strike price is $146, compared to $216 for June 2023. This is an extra $70 you pay, or around 50% more, for an option that has an expiry date over twice the age. This way, it might help you identify what strike price is suitable for you if it's a strategy you're considering. This is just to help aid those who are considering it and others who are simply interested in it and want to learn about different investment vehicles available in the markets. Remember, I am in no way recommending or suggesting you do this. In other words, this is me attempting to remove all associated liability with you potentially losing your money. I am not saying this as some sort of legal disclaimer, but I actually mean it. If you check the table here, I've taken a June 2023 Leaps contract with a $600 strike price. We can then easily calculate the intrinsic value the stock option holds at various stock prices, as shown in the table, along with the return. As the strike price is $600 and the cost was $216, then obviously you don't even break even until the stock price hits $816, but you'd hope that by 2 years' time, the stock price is above $816. At $600 strike price, you control 2.8 times as many shares for the same amount of investment. This is the amount of leverage you're able to create. We're talking about June 2023 here, which means it's up to you to decide where Tesla will be at this stage, and where the stock price might reflect the progress of the company. If you think Tesla can achieve a $1,500 stock price by then your leaps would have made 242% return, compared to the stock price at 104%. In other words, 3.5 times your money instead of doubling it. Okay, moving on to a strike price of $700. Now we control 3.4 times as many shares compared to buying at market price. If we compare it to the $600 strike price, then we haven't got any better returns until the stock price hits somewhere above $1,100. And even at $1,500, the returns are only mildly better, compared to 242% for $600 strike and 270% for the $700 strike. Alright, next we have an $800 strike price, which is our first out-of-the-money option. This offers us 4 times as much leverage, so if you could only afford 25 shares, now you can afford to control 100 shares. Remember, the reason I buy Leaps is for breakout insurance, if you like, in case the stock price breaks out that there isn't much point anymore in me purchasing any more shares, as it would cost so much money and look negligible relative to the rest of my portfolio. And this is nearly 2 years away. Now breakout could take us to even $2,000 stock price, which is an 172% increase in the current stock price, but leveraged it becomes 549%. Now this option costs $185 per share, and at $2,000 we have a profit of $1,015 compared to our $600 strike price that would have had a profit of $1,137, but cost $263 per share, $78 more per share, or 42% more expensive for only 11% more profit. And our last example is a strike price of $900. At $155, it is $30 cheaper than our $800 strike price. Now that's $30 less for a strike price with a discrepancy of $100. It does carry 4.7 times leverage. This will give you the best return if the stock price really breaks out, and who knows, it could even go up 5-fold by then. If it does break out to $2,000 though, you have a 610% return compared to 432% for a $600 strike price. It's up to you to identify where you feel the sweet spot is. Personally, I think it looks best around $700 to $800 right now, probably slightly above the stock price, when you factor in risk and leverage. But also bear in mind, I purchased almost all my Leaps when the stock price crashed below 600, so you may want to try and time the market with it too. There's always plenty of FUD that can come out, that can always take the stock price down at any time. This is important to bear in mind. I've only bought Leaps when the price drops significantly. This is part of my Leaps strategy. I wasn't consciously looking at purchasing any more Tesla stock even, but the price dropped so low I couldn't resist. If you're actively looking at buying Leaps, then it can be harder to get a good return. For me, the opportunity presented itself and I took it. That's why I'm up 50% already, despite no price breakouts. But your strategy might be different from mine, if you understand how it all works. Personally, I wouldn't really consider more Leaps unless we went down to mid-600s, but on the other hand, Q3 is likely going to be the best quarter yet, and 700s may even look cheap after that. So why do I personally buy Leaps? Well, in case you couldn't tell, I'm quite bullish when it comes to Tesla, but I feel like we're very close to a pivotal point in time with Tesla. We're about to see an enormous upgrade in capacity from their new factories, along with Cybertruck. It won't be too long before Tesla will have their revolutionary new EV batteries scaled up, along with every other associated opportunity that is coming with the company, like FSD, Model 2 and Energy. But all of these activities should be up and running soon enough. Well, at least within a year we should expect to have seen some huge progress. But can you even imagine the progress we expect within 2 years? We're talking perhaps 4 times the capacity, and perhaps an increase in 10% more gross margin per vehicle. That 10% gross margin doesn't add to OPEX, so almost all of it goes straight to net profit margins. In other words, perhaps doubling profit margins and 4 times more vehicles, meaning perhaps 10 times more net profit overall from today. I want to own as many Tesla shares as possible. I have a different perspective on it as an investment. It's all I really want. I just feel like I want to own as much of the company as I can. Bear that in mind, as it's not coming from a rational investing mindset. For example, if I was asked what would I do with all my money if Tesla went up 10 times, then I would say I would just want to buy more Tesla shares. This is my way of owning more Tesla shares, by selling Tesla shares to buy more Tesla shares, if you follow me. For example, in the past, I've sold 30 Tesla shares to buy 1 Leaps contract. So I could use my money now and buy 20 to 25 shares or 1 Leaps contract for the same price, for 100 shares. Except the Leaps contract means I own no shares, but means that within 2 years' time, I can still buy these shares at close to today's price. I feel there is a strong possibility that the stock price could be up around $2,000 by that stage. This is not my price target, I'm just saying it's a possibility. So in 2 years' time, I can buy these shares at just $800 instead. I don't have enough money at the moment to buy that many shares, but now with my Leaps, I have 2 more years to find a way to do that, and possibly through my YouTube channel, so it would really help me out if you all subscribed. Oh, but what if the stock price is only $800 in 2 years' time? Well, that's fine. I might have enough money to buy 100 shares at $800 anyway, and I'll just accept the fact that my Leaps were a loss. I've accepted that as a possibility and will not be financially ruined. Although if Tesla's stock price still hasn't broken out till the next cycle by then instead of buying 100 shares at $800, I'd probably just buy 4 more Leaps contracts. Because if Tesla follows their trajectory, one day the stock price has to break out. This is also an asymmetric investment, at least in my opinion. The returns outweigh the odds. If the Leaps cost about $150 per share at $800 strike price, and Tesla's stock price reaches $2,000 in 2 years, then that is a profit of $1,050 per share. $2,000 stock price minus $800 cost of the share and $150 cost of the Leaps leaves $1,050 profit. $1,050 profit from a $150 investment, which is a 6 times return. Now, if you think the chances of Tesla hitting $2,000 a share within 2 years is lower than 1 in 6, then it's an asymmetric investment. But remember, even if it's only $1,250 stock price, then that's still a $300 profit, or double your money. Even if Tesla are doing really well in sales and battery production and FSD, the stock price may not react accordingly as well, so you never really know. Leaps can also serve as a hedge in other areas. One such area is inflation. With what's going on in the world and the amount of money being printed, well, we don't know what kind of inflation we might see as a consequence. If, for example, the entire market rises 50% as a result, well then, that still keeps you locked in at today's prices. And if we see a huge crash, on a massive level, and Tesla drop to say $300, then yes, your options are worthless. But if you had bought shares, you'd have lost $400 per share buying at today's prices compared to the $150 per share from the options. So when the time comes for my Leaps to expire, if the stock price hasn't broken out to the next cycle or as high as I expect, I may write them off and buy some more. Also, if I sell them, I'm subjected to capital gains tax. If I exercise them, I'm not, at least where I am. Alright, that's a lot of food for thought, and I'm sure there are going to be a lot of questions, so post them in the comments below and I'll try and answer as many of them as I can. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.